What if the most boring word in crypto, stable, turned out to be the most dangerous one? You heard that right, because while Bitcoin is out here doing backflips off cliffs, stablecoins quietly moved over $3 trillion dollars in transactions last year alone, more than Visa and MasterCard combined. So let's back up and actually explain what a stablecoin is, because this is where most people glaze over and they really shouldn't. Imagine you took a dollar bill, photocopied it onto the blockchain, and told it to behave. That's essentially the idea, a cryptocurrency that's pegged to something steady, usually the US dollar. Now, here's where it gets interesting, because pegged sounds simple until you ask the question, pegged by what exactly? And that's the part nobody wants to explain slowly. So we're going to do it anyway, because the answer changes everything about how safe your money actually is. There are three main flavors of stablecoin, and they are wildly different under the hood. The first kind is fiat backed, meaning a company like Tether or Circle holds actual dollars in a bank account and prints a digital token for every dollar they hold. Think of it like a coat check. You hand over your coat, you get a ticket. The ticket is only worth something if the coat is actually still there. The second kind is crypto backed, which is where things start to feel a little like financial origami. You lock up $2 of Ethereum to borrow $1 of stablecoin, giving the system a cushion in case prices drop. It works until it really, really doesn't. The third kind is the wildest of all, the algorithmic stablecoin, which holds no real collateral and instead uses code and incentives to try to keep its price at $1. If that sounds like trying to keep a seesaw balanced, using only vibes and promises, well, you're not wrong. And Terra Luna proved it in May of 2022 when $45 billion dollars evaporated in about 72 hours. And yet, here we are in 2026, and stablecoins are bigger than ever, which is either a sign of resilience or selective amnesia, possibly both. The market cap for stablecoins has crossed $170 billion, dollars, and new legislation like the US GNIS Act is actively trying to regulate the space, which tells you this is no longer a fringe experiment. People used to laugh at the idea of using crypto for everyday payments, but stablecoins quietly became the backbone of decentralized finance, cross border remittances, and even payroll for remote workers in countries with collapsing local currencies. There's something deeply ironic about a technology invented by cypherpunk rebels becoming the financial lifeline for someone in Argentina, just trying to protect their salary from 40% inflation. Here's the misconception we need to kill right now. Stablecoins are not the same as cash, and calling something stable doesn't make it a safe deposit box. The risk doesn't disappear. It just changes shape, shifting from price volatility to counterparty risk, regulatory risk, or in the case of algorithmic coins, pure mathematical risk. So, what do the history books actually teach us here? Because crypto has now been around long enough to have history books. Every cycle, a new safe instrument appears, attracts billions in capital, and then gets stress tested in the worst possible conditions, and the ones that survive are the ones with real, audited, transparent reserves backing them up. A practical lesson is almost embarrassingly simple. If you're going to use stablecoins, know exactly what's backing them before you trust them with money you can't afford to lose. Diversifying across more than one stablecoin, favoring regulated and audited issuers, and never treating yield on stablecoins as risk-free income. These aren't genius moves, they're just disciplined ones. Because at the end of the day, discipline beats conviction every single time in this space. And the people who survived every crash weren't necessarily the smartest. They were the ones who sized their positions appropriately and never bet the whole coat check on one ticket. Process, patience, and position size. Say it with us because it will save you more money than any hot tip ever will. Stablecoins are a genuinely fascinating technology solving a genuinely real problem, and whether regulation tightens or loosens, whether new algorithmic models emerge or collapse, the underlying demand for a stable digital dollar is not going away. We can be completely comfortable not knowing exactly how this plays out, Because the right framework, understanding what's backing your coin, staying diversified, and avoiding yield traps, keeps you rational no matter which direction the wind blows. So here's where we land. The word stable in crypto is a description of an intention, not a guarantee. And the most dangerous investors are always the ones who forgot to ask the follow up questions. Stay curious, stay skeptical, stay disciplined, and remember that boring preparation almost always beats exciting speculation. If you want to go deeper on any of this, the specific coins, the legislation, the DeFi mechanics, or the historical blowups, make sure you check out the links in the description.